Stocks bouncing back today with Alphabet leading mega cap gains. This comes as the Fed prepares to meet on rates this week. Joining me here at Post 9 with her investment playbook is Elizabeth Burton, client investment strategist at Goldman Sachs Asset Management. Good to see you.
Good to see you too, Mike.
I didn't focus on, to some degree, on what the big asset allocators are up to and what the market might be giving them right now to work with. Just in terms of trying to achieve their returns, you have stocks massively outperforming bonds recently. I've been hearing a lot about, being able to lock in returns at attractive levels for the first time in a long time. Is that still an active dynamic? How do you see things?
Right. I think that's very much true. The average public pension plan in the U.S. has about a 7% return hurdle, somewhere between 6.25%, 7.5%-ish, but let's call it 7%. And for a decade almost, there wasn't the fixed income book to really pull from to get some of those returns. Now you have more asset classes to pull from to generate lower risk returns potentially. So you can actually pull back from some of the more growthy areas or high risk areas. I would say that we're still at Goldman bullish on equities, potentially over credit right now. But you can start to look at your portfolio and say, how much do I need to have in some of these riskier assets? And can we look at new sorts of investments? A good example of this is infrastructure, right? So we all know what infrastructure is, but actually it's really only 20 years new in institutional and portfolios and really still nascent in most. And if you think about private equity, which in some public pensions in the United States is now just getting off the ground, some of them aren't even at target, that's been around 50 years. So to say 20 years in infrastructure, that means you really have about maybe 30, 40 more years for that to really get off the ground and become a bigger stronghold in portfolios. And one of the reasons I believe that institutions are looking at them are there are a lot of tailwinds, but it also might be a good diversifier to portfolios right now.
I was going to say, we all know generally what infrastructure is, but as an investable asset class,
Sure.
it can be, there's infrastructure funds, hydropower or pipelines. What does it comprise? And I guess what are the return characteristics and how does it diversify away from other things?
So you went right to hydropower, which is great, but I think most people think steel, concrete, or the road I drive every day. Gosh, it has so many potholes. But you're right. It's not just steel and concrete anymore. It's a lot of things. It's fiber, it's renewables, it's data centers. And it has a lot of the same themes that we've been talking about in our 2024 outlook and even our 2023 outlook, which is the 40s, deglobalization, demographics, digitization, and I'm forgetting the fourth one here. But yeah, so it has those tailwinds. We have regulatory tailwinds. These also are typically asset heavy. Some have, pretty strong cash flows, and they have inflation protection, either regulatory or embedded in contracts, or they have such a market share they can pass some of those onto the consumer. So, really this is a position of strength for infrastructure, and we see tailwinds going on for decades.
All right, so infrastructure is the first eye. India is the other one. This is a market a lot of folks have had high hopes on for a while, but why do you think it's timely?
Okay, we're not novel here saying that we're constructive on India, but we are bullish on India, and it doesn't have a lot of place in institutional portfolios right now, right? And we've seen a pretty good run. But one of the reasons we like India, we like emerging markets in general, and we think there's a lot of opportunity there from a growth perspective. But in India, you get a lot of visibility into earnings, which you may not get into other emerging markets. And it's been consistent over time. So when we say we think there might be double-digit EPS growth there, we have more confidence there than we might have elsewhere. And similarly, it has a lot of tailwinds behind it as well.
Is that because of just transparency of reporting that you have that visibility into earnings, or just because of the fundamental drivers?
I think it's a combination of both of those things, which should give investors increased confidence to look at those markets. We are seeing a lot of interest in emerging markets. That would be one that we think has particular opportunities here.
The traditional way of thinking about emerging markets when it comes to central bank policy is that Fed eases, emerging markets get a tailwind. Is that equation still in effect?
So, I do think this year we should be less concerned about what the Fed is going to do with respect to these markets, because there's a lot of uncertainty, particularly in the last couple of weeks. We think the general trajectory is the same, right? We're going to end up in the same place, but the pace of that. So if you're going to look at these emerging markets, I'd be thinking more over the long term. I think in the shorter term, look, we usually look at emerging markets when certain things happen with the dollar, right?
Yeah, sure.
But I think we could be in a scenario in a year or two where the dollar's position has changed. And do we want to, in a year or two, start thinking about where we want to be in the world, or do we want to think about it now? And do we want to get in before, there's massive flows going into that area?
Sure. And India, I guess, is not really export driven. I mean, it's obviously what's going on there in the domestic economy.
Right, and you've got some other things there that may help diversify your portfolio. So I think if I added together what consumer discretionary and infotech in U.S. markets, it's 42, 43%. In India, that's closer to 27%. So it can add diversification, if not just an outright bullishness on the market itself.
Sure. Elizabeth, great to see you. Thanks
a
lot.
Great to see you.